Assalamu alaikum friends, welcome to lecture 73 integrated reporting. Okay, a very important topic, and also this topic many of the students has been waiting for this one. So finally it's out, and you'll be very surprised to know that this video on integrated reporting is totally different compared to all the other videos on the YouTube that you get on integrated reporting. Two reasons are there. One reason, it's not as detailed as you think it will be. Okay, and second thing, I have already included those things which I felt is very relevant for your exam purpose. Because integrated reporting, okay, there are so many things. It's a wide topic. Okay. So I don't want to waste time of my students who's watching this, who is going to watch this video. Number two, all the relevant things is there. Okay, so if you want a detailed understanding on integrated reporting, you can refer your textbook, you can see other videos on YouTube, right? But detailed and so much of knowledge on integrated reporting is not needed. Okay, for SBR. Okay, for SBR only you need to know how you report and what are the things that you report and how do you analyze a company based on the integrated reporting, the main thing. So let's start. IR, short form for integrated reporting. Now you need to know the definition of integrated reporting to understand the subject better. Okay, one definition only. Okay, you don't have to write the definition. Okay, SBR, it's a not a knowledge paper, it's a professional paper, but for your understanding, okay, this I've included it, the definition according to IRRC, that is International Integrated Reporting Council. They define integrated reporting, which is IR, as a concise communication. Concise means they're very brief, to the point, they communicate. This is like a communication tool. Okay, concise communication about how an organization's strategy, governance, performance, and prospect in the context of its external environment lead to the creation of value in the short, medium, and long term. Okay, so through integrated reporting, if someone wants to understand what is this organization's strategy, you will know. What is their governance structure, you will know. What is their performance, you will know. Okay, in the context of its external environment, based on their external environment. Okay, how are they creating value? How is this entity creating value? Value is not only, and this value is also divided further into three time period: short, medium, and long term. So integrated reporting helps to solve that issue, which was not solved through other financial statements. Right, we have cash flow statement, statement of financial position, statement of profit and loss, and other components of income, but all those financial statements fails to include these things that integrated reporting includes. Those, the financial statements, what do? They only include one type of capital, that is financial capital. They only talk about profit, that's it, only the financial figure. What about non-financial factor? How are you going to capture those? Those are not captured in the financial statements. We have seen earlier for the tech companies also, when you're measuring. So for that, we need a separate type of report that has those other factors also, non-financial factor also. So for that purpose, integrated reporting comes, has formed. So all the other factors that has not been included in your financial statements, non-financial factor, are included in the integrated reporting for your understanding, for the stakeholders understanding. Okay, that's the whole purpose. This knowledge now that you have, you are going to study in SBR, you can apply this anywhere whenever integrated reporting comes, because integrated reporting, mind you, in your ACCA you will face this in all your papers, not just SBR, whether it is your AA, whether it is your ATX, whether it is your SBL, whether it is your APM. Okay, all the papers has this topic, separate topic, integrated reporting. Okay, so you studied in one subject, you study all the other subjects, you just apply it, that's it. You don't have to study each time separately. That's the reason I've only included the main things. That is very important from your exams point of view. For any exam, you can apply this. That's why I've kept it very short and to the point. Then, because if you see, open your textbook and see, there are so many things. What is the objective of IR framework, and how is it built up? the concept of it, the foundations of all those things are not required. So I've not included it. Okay, now IR framework. They establishes two things. One is guiding principles and content element. You need to know this. That's the reason I have included guiding principles and the content element. That will tell you how the overall content of an integrated reporting should be like. Okay. And the six capital, very important. Integrated reporting, when you're studying, you have to know the six capitals. What are the six capitals? Financial, your profits and all. Manufactured, intellectual, that means your skills, your knowledge, human, your staff. Social and relationship, okay. And natural, like it could be anything, land or whatever it is, assets, your physical assets, because we believe that a company's values derive not just from their profit. It could be derived from their staff, it could be derived from their knowledge, it could be derived from their intangible, anything. So that's why integrated reporting captures all the other capital, six capitals. Okay. Financial statements only includes one capital, that is financial. That's it. That's the limitation. That's the reason we have come up with integrated reporting. It's like a holistic picture of everything. Okay. So only this things are important. One is definition. Number two is the guiding principles and the content element. And number three, the six capital. That's it. You understood this? You understood everything in integrated reporting. So starting with the guiding principles. Do not memorize. Okay, let me repeat. Do not memorize. Okay, the more you try to memorize, the more you will confuse and get confused. Okay, but read it over and over again until you understand it. Strategic focus and future orientation. Guiding principle means this will help you in the preparation of integrated reporting. Whenever you are making an integrated reporting, okay, since it's not like an IFRS standard that okay, you have a fixed standard that tells you, that guides you, okay, prepare like this is the way you have to prepare. No, unlike that, we have some guiding principles for integrated reporting. So here when we talk about it, we have to mention what is their strategic focus and their future orientation. It's like very much like predictive, like we are looking towards the future, not past, not what happened in the past, what's going to happen in the future. Okay, so an integrated reporting should include the organization strategy. Integrated reporting should say that. And also how the organization is going to create value, whether it's in the short term, whether it's in the medium term, or whether it's in the long term. Integrated reporting should include it. Okay, that means all the six capital, they have to talk about it, because how does an organization create value? Through the help of the six capital. Okay. Second, connectivity of information. Connectivity means every piece of information together makes a one big picture. Okay. So if one factor is affected, other factor also will get affected. They're interrelated, all the six capitals. Okay. Then stakeholder relationships. Stakeholder relationship means what is the organization's relationship with the stakeholders? What is the nature? What is the quality? Is it good? Is it bad? How it is? There are some more. Materiality. So whenever anything that you disclose under integrated reporting, remember you have to, not each and everything is there in the integrated reporting. Only those item or information that you feel is material, it could significantly affect their ability to create value, the organization's ability to create value. For example, if you see for tech companies, what is the value of the tech company? The most of the value of the tech company, tech like Facebook, Google, Amazon, it is derived from what? Their knowledge of their staff. So human capital or intellectual capital, this two capital is very much important that you have to include in the integrated reporting, not the other capital, not their other capital. Okay, that's one example. That means again you have to use your judgment, what is material and not. Conciseness, it should be very concise, means to the point, not too much of explanation is not required. Reliability and completeness, it has to be reliable, it has to be balanced and free from material error. Just because it's not governed by an IFRS standard, just because no specific standard is there, just some guiding principle, does not mean you can prepare the integrated reporting in any way, any order. No, it still has to be balanced. It still has to be free from material error. You purposely cannot make an error there. Okay. Consistency and comparability. if you see the word, most of this, the guiding principles, just look at the guiding principles: materiality, consistence, reliability, consistency. All these are features of what? All these are the characteristics of useful information under your conceptual framework. Remember your lecture 1, conceptual framework? We started with that. So even any information that you present using IFRS or IAS standard, they are also referring to the conceptual framework only, the same guiding principle. It's just the wording has changed. There it is under conceptual framework, here it is under guiding principles. Consistency, comparability, reliability, completeness, materiality, all this are the characteristics of useful information. If you can recall the conceptual framework, that's your lecture 1. This is what lecture 74, I think, or 73, this lecture, right? So it's the same, it's no different. But there it's more strict, okay, because there it is going to be audited at the end of the year. It's going to be checked, okay, so that's why it's more strict there. Here it's a little bit more open, flexible, but does not mean that anyway you have to be consistent. That means 1 year, if you are making presenting an information in a certain way for, let's say, human capital, next year also it has to be in a similar way, so that you can compare over the time. And also comparability, you have to be able to compare that information with other entities who are presenting integrated reporting, because integrated reporting is not it's voluntary, not mandatory. But maybe in the future they might make it mandatory, we never know, right? Now let us go to the content. All these other 1 2 3 4 the 7 guiding principles of integrated reporting. Go through it again. Content of an integrated reporting. Content means the elements. Whenever we started with our SBR, we went through the conceptual framework where there we went through the elements of the financial statements: assets, liability, income, expenses, equity. These were the 5 elements. Same for integrated reporting, also we have content, but contents are different and much more wider than statement of financial position or statement of profit and loss. So let's start. It should include organizational overview and external environment. Meaning, what does the organization do? For example, I am selling, let's say, laptop. So you have to mention I'm selling. This organization is into selling laptop. That's what my organization do. That is my organizational overview. And what are the circumstances under which it operates? External environment. Is it a regulated sector, unregulated sector? It's a monopoly, oligopoly. What is it? External environment you have to talk about. Is it a competitive market, not a competitive, all those things, okay? Governance. How does the organization's governance structure support its ability to create value in the short, medium, and long term? Governance structure, okay, I'm sure you know about governance structure, okay? If you don't know, go back, okay, or maybe you can refer your SBL for that to know more about the governance structure and all. It's there in the audit also, it's there everywhere, okay? Then opportunities and risk. There are some specific opportunities for your organization and some specific risk. Because of these opportunities and risk, if you're having a risk, it can have an impact. It can have an impact for you, okay, to create value over short, medium, and long term, okay? You might not be able to achieve that. You might not be able to create value because of this risk. So you have to handle this risk. You have to know it. It has to be there. And how the organization is dealing with them. Having opportunities and risk is one thing, and know how to deal with it is a separate thing. Just knowing it and keep it aside is not a wise thing to do. You have to deal with it also. What are you doing? For example, if it's a risk, what are you doing? Are you mitigating? Are you accepting it, reducing it, transferring it, or what are you doing? Okay. If it's an opportunity, what are you doing to take the advantage of the opportunity? Are you doing anything? You have to mention. Strategy and resource allocation. Where does the organization want to go? That is your strategy. Strategy means what? Today I'm in point A. How do I go to point B? What are my actions that I'm going to do? What is my long-term plan from me to reach from point A to point B? That is the meaning of strategy. So where the organization currently is and where in the future the organization wants to go. That's the meaning of strategy. Okay, that has to be there. And for example, now let's say I want to expand my business. How do I expand my business? Maybe I can grow it organically, or I can acquire another company, right? So this is known as strategy. Resource allocation. How does it intend to go there? Okay, now you have decided that you have to go from point A to B. We exactly know where we want to go, but how do we go there? What are the steps? Do we have the resources? Do we have the staff competence? Do we have the resources? The financial capital do we have? Or do we need more fund? This is known as resource allocation. Business model. What is the organization's business model, and to what extent is it resilient? Okay, just now previously, uh, I was just surfing the net some time back, and then I was going through a company. Okay, they were in a business model of buying a shoe, right? They're selling a shoe. Selling shoe to what? To low income family. So their main focus is in the short term profit, not in the long term profit. They are not investing in their staff. They are not training them. They're not into recycling. So it's a business model. It's a business model which is not sustainable. So likewise, every organization has some business model. And to what extent is it sustainable or not? It has to be there. Performance. Performance in terms of the six capital. Your natural, financial, human, social, all those capitals. Okay. How much have you achieved in terms of the objective that you have set for each six capitals? Performance is something easy. Future outlook. What are the challenges or uncertainties that you are going to face? Your entity is going to face to pursue the strategy. Okay. And also, what are the implications of this on your business model and the future performance? So, if you see integrated reporting content, it's very wide. All these things were not there in your financial statements. Okay. Basis of presentation. How do you present? Okay. That means how does the organization decide what items to include, what items not to include in the integrated reporting? What is that deciding factor? And how, after you have decided that you are going to include, how are such matters quantified or evaluated? How do you quantify? How do you put a value for those things? You need to write it in your integrated reporting. Integrated reporting talks about this, okay? So now let's start this question. I see it. So this is a very similar question. Yes, exactly. I was talking about this question, the business model. Okay. Anyway, let's finish this with test your understanding 8. Test your understanding 8 AA. So the requirement says that why would an integrated report provide useful information about doubling? Okay. But before answering this question, we have to go through some facts, right? Because integrated reporting is not just about one thing. Okay, there are so many things, so many items that has to be included, as we have seen from our elements that has to be there in the integrated report. So now let's read the case and try to understand this, why an integrated reporting is useful in this case for this company. A is a UK-based public limited company that purchases shoes directly from manufacturers and then sells them through its own UK-based shops. Okay, so I hope that you have understood, you have picturized the scenario. Okay, so it is about a shoe company purchasing it from someone else, from the manufacturers, and then they sell through their own UK-based shops. Okay, they purchase it from abroad and then they sell it in their own UK-based shops. Okay, and they have been profitable for many years. So the key information is that they has been profitable for many years, and they have continued to expand, financing this through bank loans. Okay. Now their shoes were selling particularly well amongst the lower income families. Okay, so this is they are giving you the segmentation of that shoe. They are selling into this group, lower income families, and therefore they have targeted this demographic. They offer a discount of 50% on school shoes if the child is entitled to free school meal. This discount is particularly subsidized by a government grant. Now, They maximize its profit by buying its inventory from overseas. How do they maximize this profit? By buying this inventory from the overseas. In the past, they have some press report that says that they have been having some poor working condition, okay, and also the pay in factory, okay, where these products are manufactured from. There, the working conditions are poor, and also the payment in the factory is not so much. They're exploiting the labor. That's what the press report was saying for the several years for double A. So now double A became more conscious and they feel that they have to monitor their suppliers' employment conditions. A has been criticized for the quality of its product. They have been criticized. Some customers have complained that shoes are not well made. They need to be regularly replaced. And also, according to a major customer magazine, they say that double A products are false economy. Okay, they are saying that customers will save more money if they prefer slightly more expensive shoes, okay, but better quality shoes in the long term rather than buying from the double A with the lower cost. Because remember the demographic of double A, lower income family. Even the staff who work there are paid the national minimum wage. Training is very minimal and staff turnover is extremely high. So this is not something, it's a negative things, okay? These are negative things they're talking about. They do not engage with local or national recycling also. They do not. Okay, and the director believe that increasing this, okay, that means taking this initiative, for example, to recycle, to train your staff are costly. And because of that, your operating cost will increase. That means if your operating cost increases, you cannot sell at a lower price to your customer for the target demographic because your target demographic is what? Lower income family. Lower income family. To sell at a lower income, your cost has to be low. But if you take this initiative to train your staff, to recycle, it's costly, right? So that's what the directive feels. Now, the success of the double A business model, okay, because there was a success in the double A business model, what happens now? Competitors are increasing in that sector. Everyone wants to buy shoes, sell shoes, okay. Even though these competitors they do not have the same presence that double A does, still what did they do instead? They invested more in the online stores, the competitors. But double A, okay, even though they had a website, they couldn't purchase anyone if they want to purchase shoes online, they cannot do it under double A from their website. Its products cannot be purchased online. So that's again a disadvantage. So whenever a question comes, why would an integrated report provide useful information about double A? Whenever this question comes, directly they will not say okay what are the elements, what are the guiding principle or the six capital. No, sometimes they might say about six capital but rarely they talk about six capital. Indirectly they will ask you like this, you have to talk about six capitals. This is the meaning of this is the six capitals, refer this to the six capitals. Sometimes out of the six capitals, looking at your scenario, it's not possible that you get information about all the six capitals. Maybe two or three, whatever you get, take it from there. Okay, most of the time financial capital information will be there, or in this case human capital also we have, and maybe manufactured capital. There are other types of capitals are there, right? Six capitals that we have gone through in the beginning of this video. So now we are going to use the knowledge of it to answer this question. Okay, now let's see the answer. So if you go through the answer is pretty big enough. Okay, so how do you write this answer? How do you come up with this answer? And then we have a summary here. Summary part will go later. Okay, that means we are summarizing everything. First of all, integrated reporting. Make sure that you keep it balanced. That means positive side also you have to talk about, negative side also you have to write in your answer. Okay, what it's trying to show you. So in this integrated reporting, they highlight some positive issues about this company. What are those issues? You can talk about it based on the capital. Whenever you're writing under integrated reporting, make sure that you categorize it in their form, the correct capital. For example, this is financial capital, this is human capital, this is social capital. You should be able to do it. Okay, and the easiest one is start with the financial capital because that's the easiest. Most of the time, whenever they give you some figures and all, it's financial capital. Financial capital means your profits and everything. So you can start with that. That's your starting point. So first bullet point talks about financial capital. Financial capital means the profitability of the company. So it has increased, right? In the current business activity, profitability is there, success is there. So that means in terms of financial capital, it's good, it's positive. Coming to the second, okay. Again, they are talking about financial capital, but it's a second bullet point because it's more than profitability. Okay, what is it? Be very specific. You have to specifically write like this. Okay, so financial capital, again it will increase. This time it's not because of profit. This time why it will increase? Because of the receipt of garment. Remember, garment will give you some grant, will give you grant. Okay, so because of this, that you are receiving the grant from the government, it will help the double A to repay its debt. Why debt? Because they are taking loan to expand. Remember, in the first few line it was given in the short and also in the long term or the medium term. So again, financial capital is increasing. Now the third one is talks about social capital. Social capital. So you see, it does not include all the six capitals, but at least out of six, two capitals are mentioned. Financial capital, they are talking from two different perspectives. One is profitability, other one is government grant. Now, social capital. Social capital means all your relations and all, social relationships and all. Social or relationship capital is the same thing. Here also they have a positive impact. How? Because they are focusing on low income family to buy essential items of clothing. Shoe is also considered as a part of clothing only. And clothing, we know their nature is that they are essential items. We need it. Everyone needs clothes. You cannot say rich does not wear clothes, only poor. No, everyone needs clothes, whether you are rich, whether you're middle, whether you're poor income family. So it's an essential item. That's the reason that if you charge low, everyone can buy, because essential items prices have to be low. You cannot increase it. So because they are charging low, and for low income family, this will have a positive impact on the social capital. Okay, so because of this, what happens, it's likely to foster brand loyalty. More and more people will come and buy your product, they'll be loyal to you. Okay, and because of this, good publicity, because I told you social means relationship capital is the same thing. So good publicity and all will create better relations with your customer, with your supplier. So because of this, again, this will have an impact in your financial capital. It will help your financial capital. That means your profit will go up only in the future. Understanding? So this is how you need to link with the among the capital, and you need to talk in different paragraphs. You can talk. When you're writing this answer, don't write in bullet points. Okay, write in proper sentence. Okay, but you can obviously divide it in different you can write it in a paragraph form. Okay, different paragraphs you can write. Now let us go here. These are some drawbacks. So first you start with the positive. Okay, another question students often ask me, how do you write when we have pros and cons? Start with the positive side first. Always, anything you have to talk about, always start with the pros, the positive side first, and then the negative side. Okay, so positive side is over. Now we are talking, we have more for the negative side, in fact. Okay, so it could be argued that this business model will not create values in the long term. Okay, in the short term, okay, profit is increasing, they are getting grants from government, they are investing in low income family, but what about in the long term? Is it sustainable? No, their business model is not sustainable. It will not create value in the long term. You have to mention this word value in your answer when it comes to for integrated reporting, whether it's in the short, whether it's in the middle, or whether it's in the long term. In this case, in the long term, this business model will not create value. How do we know that? Through this certain things. It's answered in different bullet points. Okay, so now we are going to refer to that one by one. Different paragraph, use different paragraph to answer it. One point in one paragraph only. So first paragraph talks about government grants. Looking at the first word of the first sentence, I know this is the this is all the paragraph is about. So the government grant. See, government grant, no entity keeps on receiving government grants from year to year. It's something that it's a one-off, or maybe 2 or 3 times you will receive initially, but not forever. It does not happen that every time you keep on getting it. So it does not continue indefinitely. Okay, what does it mean? Because this could be maybe due to the government budget. If the government cuts their budget, how are they going to give you grants? They cannot. They have to cut their government grants also. Or maybe because of increasing competition. Okay, or maybe as a result of ongoing quality issues with the AA products. If the AA products are not up to the standard, government will not give them grants. So government in this condition can stop that grant. So the financial capital that you are having an advantage here, the second paragraph under the advantages, the positive side could become a disadvantage also in the long term. We are talking about in the, see, always change the horizon, the focus. Okay, when we talked about advantages, they were focused on the short and the medium term, but disadvantages, now we are looking in the long term. We have just changed, the points are same, the horizon has changed. So government grants in the short term, yes, but not in the long term. Okay, now coming to the second point, human capital. Okay, see how they are mentioning it and referring it to the capital, six capital. So if you see human capital, they did not invest in training, hence human capital has to be suffered, right? They are not investing here in the human capital. And because they are not investing, what happens, always talk about the drawbacks. If this does not, if they are not investing, what are the repercussions of it? You have to talk the consequences. Okay, the cause and the effect. So unskilled or untrained, you think they can boost your brand? No, they cannot. They cannot achieve that brand loyalty. They cannot foster the brand loyalty. Maybe in the short term, okay, not in the long term. So because of this, loss of customer over time. It's not custom, it's custom. Over time, over the time, long-term customer will reduce. No doubt about it. You need skilled and you need trained staff for it to be sustainable. Third point. Okay, third point is also relating to financial capital. Okay, but here we are talking about the labor. Again, labor. Here also human capital only, but we are not talking about trained or untrained, skilled or unskilled. We are talking about cheap labor from overseas. Okay, so the word is cheap labor from overseas. Okay, it's true that because you are using cheap labor means your cost is reducing. So in that way, okay, it will increase your financial capital, true, but it will lead to a net decrease in other capitals. Remember, when you're studying the six capitals, they are related with each other. If somewhere it's improving, the other places the are suffering because of that. Remember that. Okay. So because here it's increasing, other places is decreasing in the other capitals. How? It's not enough to say it will decrease. You have to show also. You have to prove it. So this 2 point says, even though they are having cheap labor, but they are criticized for it. They are criticized in their local communities that they are not investing highly on the labor. Hence, they are exploiting the overseas worker by giving them low wages. So if they don't invest in the human capital, what happens? This will have a negative impact on the social as well as and relationship capital. Okay, because if you're investing in human capital, you're training them, they are skilled, they can foster your brand loyalty. Okay, hence increasing your social capital. Okay, they will be having a better reputation, you know. Second, so remember there was a point that because of this criticism and all, the AA feels that they need to now monitor their supplier very closely. Okay, so because there is an urgency, there is a need to monitor the supply very closely, indicates that the current economic benefit may not be sustainable in the long term. The benefit that they're receiving currently because of cheap labor, increasing their financial capital in the long term is not sustainable. Okay, now purchasing goods from overseas. Again, same issue but from different angle we are talking about. It will increase the carbon footprint. Remember that shoe has to come from so many places before it comes to you and then you sell. So coming from all the way, carbon footprint, because it has to come through airline or ship or whatever. And also more to that, they do not recycle also. They are not taking the initiative to recycle. So it's again a added disadvantage. Okay. So because of this, your natural capital suffers. It's draining. Okay. So because of this, it will deter some investors and consumers. They will not be happy with this. And I think yes, this is the last point before we summarize everything. Another thing is on the high street expansion. Okay, they have been currently focusing on expansion. Expansion means high street, they want to expand. So because of that, they have to take loans from the bank, right? Okay, but remember, even though they are focusing on high street expansion, competitors are not doing like that. Competitors are focusing on setting up online. They want to sell through online. So because of this, AA will now become it's a threat for AA. It's a threat. Okay, because same product their competitors can offer at a lower price cheaply in online. And also since AA they didn't invest in their staff, this will compound, this will increase that risk further. Risk from whom? The competitor, online competitor, because staff are not trained to work on the online. Remember, you have to train them. Okay, the services, the experience that you get from online you cannot get from the retail store because staff is also not trained. Okay, so in the medium term, the medium or long term, the current business model will not it's not stable model. Okay, it's not sustainable. Now we are talking about summary. Whenever we talk about summary, summarize everything. Here we just broke down every piece of information and we explained how integrated reporting will help here. So definitely integrated reporting will help for various issues. As you can see, all the disadvantages, advantages which we have covered here will not be covered through other financial statements, which integrated reporting covers. So summary is, okay, basically snapshot of the company in short. Okay. Number one, business model, it is profitable. So this financial information, whether it's profitable or not, you can easily get it from the financial statements. There is no doubt about it. Take out the statement of financial positions, take out the statement of profit and loss. From there, you will see whether it's profitable or not. Compare with the previous year, you will understand. Okay. But what does integrated reporting looks at? Integrated reporting, the main thing that they look at, value creation. How much value you have created using the six capitals. That's what integrated reporting looks at. And also the stability, whether they are going to be stable or not in the longer term. This may offer more pessimistic outlook, you see, because everything was negative. They are not investing in the human resource, they are not recycling, then they're exploiting their overseas worker. All those things are not, it's negative. You can understand, right? Now we are talking about banks. Why banks? Because they want to expand and they have to rely on the banks. So banks also, if you see, they are also now, they are more likely to invest in those companies that have a sustainable business model, unlike AA. Therefore, in this case, integrated reporting will help them to make stronger investment decisions. Help whom? Help the bank, whether they want to finance, whether they want to help AA or not, looking at their business model. How will they know it? Through the integrated reporting. So in this case, integrated reporting is helpful. Yes, it's helpful for the bank. What about other investors and all? Same. For other investors also, it will be helpful. Now, remember, integrated reporting is not mandatory. It is something which is done voluntarily, right? If you want, you do it. If you don't want, you don't do it. It's not mandatory. Like how statement of financial position, statement of profit and losses. Okay. So usually what happens, businesses which have a detrimental net impact on capital, that means negative impact on other capital. That means especially non-financial capital. Why especially non-financial capital? See, financial capital, profit and all, whether it's positive or negative, through the statement of your financial statements, you will be able to figure it out. But non-financial capital, how do you know about non-financial capital? Only through integrated reporting. So because of that, if your non-financial capitals are suffering, usually what happens, you do not want to disclose it in the integrated reporting. You voluntarily don't want to do it because you know you have nothing positive to show. But in contrast, for those companies who create value, Okay, in a sustainable way, they want to disclose this to the user. Okay, if this becomes mandatory, the preparation of integrated reporting, then what? Then it will motivate a company like this, double A, to shift their focus. Now their focus is to make short-term profit, 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 profit. But if integrated reporting becomes compulsory, they will shift this focus from short to medium term. Sorry, short to medium and long term, using different types of capital, not just focusing on financial capital. Now they are focusing on just short-term financial capital, only one capital. If they change to integrated reporting, they will see array of capitals. That means all the six capitals they will consider the impact on over the medium and long term. So overall, you can say yes, integrated reporting is useful because of this issues. Okay, so that's it for integrated reporting. So that's it for integrated reporting, and the last topic under analysis and interpretation is not-for-profit entities. Before we move on to the current issues. So till then, thanks for watching and see you in the next video.